So the premise of tonight's talk is really about this hidden gem, this gold in your home. And part of that is, in my opinion, we've got some challenges ahead of us, right? Retirement cannot be done the way that retirement used to be done in the past. Americans on average feel they need $1.9 million in order to secure a comfortable retirement, and yet on average, households have roughly $233,000, okay, on average, by the way. And people with uber wealth bring that average way up. If you take the median number, it's well under $100,000, okay? And retirees on average have over 70% of their net worth tied up in their home. So that's what we're really talking about today, is the home. With that being said, I believe we've got an impending retirement crisis on our hands. There's something called Peak 65 that's happening right now. We've got 12,000 people turning 65 years old every single day in our country. We've got fewer pension plans and defined benefit plans, right? So if you've worked for your employer for 20, 30 years, typically, unless you work for the federal government, you're not typically receiving a pension. That was replaced, generally speaking, with the 401k plan, okay? And you have to put in order to get out of that plan, right? We've seen the lowest return on our own investments in decades. So you think about retirement in the 80s, whether it was your parents or your grandparents who were retired in the 80s, they could retire off of a pension and CDs. CDs were paying double-digit rates of return, literally, right? That doesn't exist today. So we have to reconsider how we do retirement. And because of this, more than 60% of people are planning to delay retirement. Not because they love what they do, but simply because they can't afford to retire. Inflation, as we know, is a killer because that devalues the dollar, making every dollar we spend worth less because of inflation. This one scares me the most, that less than 7% of Americans have some sort of long-term care insurance, and more than 70% are likely to need it. And if you are married, that number goes up over 90%, that one of you is likely to need some sort of long-term care. And it's not cheap. And for most of you, you probably understand, that's not covered by Medicare, right? Long-term care is not covered by Medicare. We have to have a plan. How is that covered? Whether it's long-term care insurance, whether it's self-pay, or whether it's living in your kid's basement. Right? Those are really the options unless you want to rely on Medicaid. Okay? And obviously, we're living longer, which increases the risk of running out of money. Mathematically speaking, if all baby boomers retired at the age of 62, 84% are in jeopardy of running out of money before they die. And if all baby boomers retire or delay retirement until 66, half of them are still in jeopardy of running out of money before they die. This scares me, guys. This is worrisome. Half of our senior population, if you will, is in jeopardy of running out of money before they die, which is creating these concerns today. Number one, the fear of running out of money before you die. Will your nest egg outlive you, or will you outlive your nest egg? It's a rhetorical question, something to think about. Right? Number two, healthcare costs are through the roof. Most people that I speak to say that the average cost of in-home care, okay, is over $100,000 a year. $100,000 a year for in-home care. Do you have a plan? Do you have long-term care insurance? And number three, uncertainty about Social Security and or Medicare benefits. Okay, this is not a political discussion. This is not about who's in office right now. This is just the fact of, is that going to be in place when you go to retire? And or will the age be delayed such that you're not eligible for Social Security benefits until a later age, or Medicare until a later age? how do we plan for these things? Okay, so this, I believe, most people end up in one of these 4 categories as you're thinking about retirement. Number 1, I need immediate help. Okay, and there's no secret, we're going to be talking about reverse mortgages today. Historically speaking, the reverse mortgage has been used for this category and this category alone. I need help, and I need help now. As a matter of fact, all the advertisements and commercial and marketing have been targeting this group. Okay? Or are you in bucket number 2? I'm okay now, but I will have a challenge down the road. This is what I call the impending train coming down the tracks. Right? You see it coming. You know it's coming. What are you doing about it to be prepared for it? Or number 3, I'm good unless there's a medical event, unless there's a passing of a spouse, loss of a job, right? Divorce. The fastest age demographic of divorcees in our country today is 55-plus-year-olds. I don't know why. Maybe people have just gotten tired of being with their spouses and said, I'm done with you, forget it, I'm going on my own. But the point is, once that happens, okay, financially it creates a major challenge for folks. Or are you in category number 4? I'm in great shape, but now I'm just thinking about legacy planning. I'm thinking about causes and my children and or heirs. Again, historically speaking, the industry is focused on that first group of individuals. I need help, and I need help now. I'm here to provide you some information. If you find yourself in category 1, 2, 3, or 4, where this might be of value, I believe that our country, generally speaking, has done a great job education-wise on planning and saving for retirement. Okay? I call this the Mount Everest analogy. Okay? Climbing Mount Everest. Many people train a lifetime, if you will, to climb Mount Everest. Okay? Saving for retirement is like climbing Mount Everest. It's your accumulation phase in life where you're saving and planning and saving and planning. Right? But what happens when you reach that peak? You have to descend. And most people die on Mount Everest in the descent, not the climb. People are not prepared for the descent. How do you create a plan? What tools do you put in place so that you can descend the mountain safely to avoid running out of money before you die? Does that make sense? This is the elephant in the room, folks. $14.4 trillion, and Souter likes to correct me because he's read something recently that says $17 trillion of home equity controlled in our country by homeowners age 62 and over. Now that's a big number, 14.4 trillion, 17 trillion. I get lost with the zeros. But the point of this slide is the fact that there's $16.8 trillion worth of IRA money in our country combined. Right? You've got $9.3 trillion of 401k money in our country combined. Think about this. There's several financial advisors in the room here tonight. I can almost guarantee you that 100% of you would answer this question the same way. Why do you put money into a 401k or an IRA? Anybody?
Save for the future.
Retirement. Save for the future. That's right. Does anybody here work with the sole purpose of putting money into a 401k to leave it for the next generation? I see a couple no's. I haven't heard a yes. I hear a couple laughs. Interestingly enough, folks, we've got trillions of dollars that we put away in retirement with the sole purpose of using it, and yet there's this entire behemoth of $14 trillion sitting on the sidelines that people are ignoring. And guess what? It's the most tax efficient, most friendly asset that's in your entire portfolio. I'm not kidding. Okay? Guess what? When you put money into an IRA, you either pay taxes now or you pay taxes later, right? Roth IRA versus a traditional and so forth. 401k, it's deferred, but you pay taxes at some point. Somebody once told me that it's because they have to get theirs. Theirs is the IRS, right? Home equity is the only asset class that I know of that you do not have to pay any taxes on when you take it out of your house. And I'm not talking about when you sell your house, that's different because that could include capital gains taxes. But what I'm talking about is taking cash out of your home while you're living in it. Okay? There's really 4 ways to access equity in your home. Sell your house, and there's some realtors in the room here. If anybody wants to sell their house, I'm sure they'd be happy to help you. Raise your hand. It's okay. You don't have to be shy. Okay? And I'm not here to say you shouldn't sell your home. Okay? At some point, if your home's not appropriate for aging in, that might be the best option. But that's option number 1 as to access equity is sell your house. Number 2 is do what's called a cash out refinance. Right? Take cash out, you increase your mortgage balance, and guess what? You increase your monthly payment. Number 3, HELOC or home equity line of credit, same thing. You take a mortgage, increase your liability, and you increase your monthly payment. 4th option is a home equity conversion mortgage or reverse mortgage. This is the only option you have to access equity without increasing a payment and without selling your home. Period. There is no other option. Okay? So I'm here to brainwash you. No, I'm just kidding. I'm here to create what's called a paradigm shift. And a paradigm shift is simply a change in the way you think about something. Okay? Because again, a reverse mortgage has always been viewed as a loan of last resort. Or again, that category number 1 where people need it and need it now. They have no other choice. I'm here to help you understand through math and through education that actually a home equity conversion mortgage is better utilized earlier in life when you don't need it to protect against something and to plan for something. Okay? There's an individual named Dr. Wade Pfau. Dr. Wade Pfau has actually written multiple books. Again, for the financial advisors in the room, you probably know this individual. Okay, he's a professor of retirement income, and he's written a book and proved mathematically through what's called Monte Carlo simulations that you're actually better off mathematically doing a reverse mortgage earlier in retirement when you don't need it to protect and preserve your other assets and pay less in taxes. So what is a home equity conversion mortgage anyway? Okay? Home equity conversion mortgage, first of all, is another name for a reverse mortgage. Okay, home equity conversion mortgage is the name of the FHA, Federal Housing Administration, product that was created in 1987 under the Reagan administration that Congress created. But there are other types of reverse mortgages. But bottom line is it's a mortgage that allows homeowners the ability to access equity in your home without having to make a payment of principal and interest. Number 1. Number 2, it's a mortgage that increases the purchasing power for buyers because you can borrow money without the requirement of making a payment. So yes, you can use this product, realtors, to purchase a home, and instead of your client buying a home with cash, they're able to buy a home utilizing a reverse mortgage, increasing their purchasing power, not having a monthly payment, and keep some cash in the bank. Make sense? Okay? Number 3, it's available again in a variety of products for both purchases, refinances, a home equity conversion mortgage, which starts at age 62, or what we call proprietary products that start at age 55 now. Okay? Lots of options. The best feature and my most favorite feature of all, and I've got a couple slides on this, hopefully we don't run out of time. Put my phone down so I look at the clock, is the growing line of credit. The growing line of credit. I'm going to focus a lot on this toward the end because this is the most amazing insurance policy that you can create. Using your home equity to plan and prepare for anything that might come your way. Okay? It's absolutely fascinating. Lastly, the loan balance grows over time because the interest on the loan is deferred. So think about when you make a mortgage payment, you take cash, you make a payment, and in exchange you have more equity. Make sense? Okay? This simply doesn't require a payment, so the interest is deferred and the balance goes up as opposed to down. Everybody got that? And the footnote at the bottom, as long as you occupy the home, pay taxes and insurance, and maintain the home, you never have to worry about paying this loan off. The loan becomes due and payable when you either choose to sell the house or after you pass away. If you live in the house the rest of your life, you arguably never have to pay this loan back. Some misconceptions. These are the top 5 misconceptions that we see on a daily basis. Number 1, that the home has to be what we call free and clear or debt-free. Okay, that's incorrect. The most common use case for a reverse mortgage today is to pay off an existing mortgage balance, get rid of that mortgage, and free up monthly cash flow. Make sense? Or a home equity line of credit. Number 2, the borrower and or the heirs will be left with debt in excess of the home's value. This is the most important point here. This is what's called a non-recourse mortgage. Non-recourse mortgage. In the loan documents, it literally says you have no financial liability for this loan. If the loan balance ever exceeds, I know, right? Crazy. Did I blow your mind with that one? Melissa, am I wrong? It's what it says in the loan documents in the closing package. The borrower has no financial liability. The loan is secured against the house. The house owes the money. Okay? As long as you own that house, that loan is tied to the house. Okay? Doesn't go on your credit report. There's no monthly payment. And the heirs cannot inherit a debt. So if the loan balance grows above and beyond the home's value, okay, on the FHA product, the mortgage insurance covers any shortfall or any deficit. Okay? Number 3, I can no longer sell my home. I'm going to call up Bob here in a little bit. Bob is a great friend and a client. And Bob, like others, has gotten a reverse mortgage and is actually selling the house, paying off the reverse mortgage, and is retaining the remaining equity in the house and is able to use that equity for anything they want. We have numerous clients who actually sell a house with a reverse mortgage, go purchase another house and get another reverse mortgage. Nick, you met with Angie this morning, who's in that exact situation. Selling a house that we got her a reverse mortgage probably 5 years ago, roughly. She's buying a house in the Peloton right now, a condominium in the Peloton, with a reverse mortgage. Okay? Number 4, the lender takes ownership of the home. False. Brandy with Heritage Title, thank you for sponsoring. Thank you for being here. Lender doesn't take ownership. No. The homeowner continues to retain ownership. Yes? You can have title in a trust. You can have title with an adult child. They can't be on the loan because you've got to be of age to be on the loan. Okay? But you retain title. The lender does not take title. And lastly, the reverse mortgage, again, is best or only utilized as a loan of last resort. As I mentioned a couple times, Dr. Wade Fowle has proven mathematically that's absolutely incorrect. It's best utilized at an earlier age because of that growing line of credit. So let's talk about some fundamentals. Okay? How much equity can you access? It's based on 3 main factors. Okay? Age of the youngest borrower, 2, current interest rates, and 3, the home's value. Okay? Let me explain, roughly speaking. Okay? Loan to value is probably the term most people understand the best, right? How much loan can you access relative to the value of your house, yeah? With a reverse mortgage, generally speaking, today that ranges around 35 to 55%. If you are 55 years old, you're probably looking at close to a 35% loan to value. If you're 85 years old, you're probably looking at about a 55% loan to value. Everybody follow? The younger you are, okay, the less you can borrow. It's based on actuarial tables or life expectancy. Okay? Number 2, interest rates. Okay? Lower interest rates are, okay, the more you can borrow because there's less interest being deferred. Right now, interest rates are around 6 to 6.25% on these programs. Not bad, yeah? Historically speaking, I think that's pretty darn good. Okay? How can you access equity? There's 3 distinct ways. 1 is called a lump sum, 2 is a monthly payment plan, or 3 is a line of credit. Okay? That lump sum is taking cash out right away. That's used to either pay off a mortgage or a HELOC, pay off debt, take cash out, give it away, go on vacation, buy a second home or investment property. That's what people use the lump sum for. Number 2, a monthly payment plan. This can be created for either a certain period of time, which is called a term payment, or for life, which is a tenure payment, like an annuity. You think about that. You go out and you buy an annuity, you give your financial advisor money, and in exchange, they give you a payment for the rest of your life. This is annuitizing your home equity. Your home equity is now paying you for the rest of your life, arguably. Okay? Number 3 is the line of credit, which I'm going to show you. Calm down, relax, it's okay. I'll get to, I promise. Or a combination. So in a lot of cases, we'll do a combination of strategies. So we'll sit down with clients and we'll figure out what you ultimately are looking to achieve today and in the long term, and what's the best structure for you, so that we can put together a plan that achieves your short-term and your long-term goals. Make sense? So here's just a laundry list of strategic uses. Okay? Number 1, asset strategy. For the financial advisors in the room, people with assets under management, this is what I call creating a buffer asset. Okay? This is creating your home equity in another bucket of money that you have access to tax-free to protect and preserve your assets under management, your portfolio, right? Your 401k, your IRA, your mutual funds, and so forth. The idea being that you protect those assets and you don't spend those assets prematurely, so you avoid paying unnecessary taxes. You allow those assets to grow more. And the worst thing you could do, financial advisors, help me out, is to take money out of the market when the market is what? Down. Right. How's the market doing right now? Pretty darn good, right? What goes up must come. That's right. At some point, the market will take a downturn. I'm not hoping for it, don't get me wrong. But historically speaking, it always happens. And it will recover. It always has. The worst time to take money out is when the market's down, yeah? So creating this buffer asset is the smartest thing you can do to protect against when the market takes a downturn and you don't take the money out and lock in those losses. If you are taking money out of a retirement account that's taxable in order to simply make a mortgage payment to create illiquid equity, we need to talk. Does that make sense? Taking money out of a taxable account to pay a mortgage to create illiquid equity, that's the number 1 strategy that we can help to achieve cash flow and protect and preserve assets. Number 3, covering bills. We have a client right now who has $120,000 in credit card debt. Okay? And their home is virtually paid off. After we sat down and went through for about an hour and a half their finances and the situation and put together a plan, and they're paying roughly 20% on average on credit card debt, it was where do we go from here, right? This solution will improve their cash flow by about $6,000 every single month. Okay? Retirement home. Again, you may not be in your forever home. Okay? You might want to move at some point. Right? Talk to one of the realtors in the room. Got a lot of great realtors in the room. But if you want to move, when you go to downsize or right size, let's say you're selling a house for $700,000 and you go to buy a house for $500,000, consider using a home equity conversion mortgage for that purchase so you don't tie up all your cash. Again, the house you live in today might be the perfect house, but it might require some work to safely, comfortably age in place. Right? Grab bars, handrails, ramps, bathroom remodel, kitchen remodel, whatever it is. Okay? Why not use your home equity to make the home nicer, better, worth more, and more comfortable for you? Great way to use home equity. Growing line of credit, have I said it enough yet? Have I gotten you guys excited about this yet? Okay, this is truly the magic in this product. I'll show you, I promise. Delaying Social Security. Okay, I'm not a financial advisor. We've got several in the room, but I understand the math. That if you delay collecting Social Security from age 62 to 67, okay, you give yourself effectively a 30% pay raise. If you delay collecting Social Security from 67 to 70, okay, you give yourself another pay raise of about 24%. Okay? I'm not here to say everyone should delay collecting Social Security, but I'm here to say that that's a strategy. You can delay collecting Social Security to give yourself more money in retirement and use a home equity conversion mortgage to create cash flow in the interim. Make sense? Yeah? In-home care, we talked about the fact that it's expensive. How are you going to cover that cost? Right? Do you have insurance? Great. If you don't, this is a great way to use home equity to cover that cost. And then gifting. If you are in that far right category where everything's taken care of and now you're just thinking about causes and errors and nonprofits, I love it. Okay? I have a client in California who was a musician her entire life. Okay? And she literally did a reverse mortgage, took $100,000 out of her house in order to give it to her alma mater as a legacy gift while she was alive. So she was able to see the power of that gift as opposed to leaving it while she was gone. Because once you're gone, you don't have any control. But the ability to see and feel what that money and what your wealth can do while you're alive is a gift in itself. So paying off a traditional mortgage, this is just a simple illustration. If you had a $300,000 mortgage at, 5%, okay, that payment might only be $1,610 a month. You might say, Gabe, I can afford that. Okay, not a big deal. But what people don't think about is that's almost $580,000 of cash that's required to service that payment. It's a lot of cash, right? So getting rid of the mortgage payment is number one. Okay? Let's talk about the line of credit. Nick, how much time we have? 15 minutes? Okay. This is a simple illustration. Remember I said what was the loan to value range I gave you guys earlier? Anybody remember? Thank you. Good job. You guys are listening. I love it. 35 to 55. I gave a simple math equation here because I'm simple when it comes to math. This is an example using a $600,000 home value with a 50% loan to value. Okay? Which means that this homeowner or client can access roughly $300,000. 50%. Everybody follow me so far? Okay? The assumption here is that the balance that we're paying off on a mortgage is $80,000, and there's about $20,000 in upfront costs to set this up. Okay? So this client's using about $100,000 in order to pay off the mortgage and finance the fees. The out-of-pocket cost for this right now is about $145, just so you know. Okay? That's what is required, called the required counseling session. Okay? Everybody who does a reverse mortgage has to actually meet with a third-party approved counselor. It's a government regulation, it's a consumer protection. Okay? It's about $150, $145 to do that. That is your out-of-pocket cost. Everything else can be financed. Again, in this example, client's using $100,000, which means there's $200,000 left over that we're going to put into the line of credit. Everybody see that? Okay. Now, current interest rate is actually lower today at 6%, but I use 6.25%, which it was in the last couple weeks, because I don't know where rates are going in the next couple weeks. But the idea being, if interest rates are 6.25%, and these products are insured by FHA, there's a 0.5% of mortgage insurance annually. Okay? Which means the total effective cost is 6.75%, which also means the line of credit is growing at that same cost, 6.75%. Let me pause. Does that make sense so far? The cost is 6.75% with the rate plus the mortgage insurance. So the $100,000 that's being utilized is being charged at 6.75%, and the $200,000 that's not being used is growing at 6.75%. Everybody follow so far? Okay, very important to understand this, because I'm going to blow your mind here in a second. Okay? So, this shows you over a year, 5, 10, and 25 years what's going to happen. Okay? I don't think I have a laser pointer on this thing, so I'm just going to show you. After 1 year, you can see the home at a 4% appreciation rate goes to $624,000. Okay, realtors in the room, what's the average appreciation we've seen in Colorado the last 20 years? 4 or 5? 6? Okay. So using 4% is a low average. By the way, I use that because that's the national average historically. Okay. After a year, the total credit limit grew by 6.75%, and the balance of the loan grew to 107, and the available credit grew to 213,000. Everybody follow the math? It all grew at 6.75%. Fast forward 25 years real fast. Okay? Home value is roughly $1.6 million based on 4% appreciation. The loan balance, I know, call it crazy, you borrowed $100,000 and you only owed $80 right here, and now you owe almost $600,000. Some people might think I'm crazy and say, Gabe, that's about $500,000 cost on this loan. However, this is the magic right here. You've got almost $1.2 million in tax-free cash that you have access to do anything you want. And the reason I picked 25 years is because if you did this at age 62, that would put you at about 87, which is when things, unfortunately, are going to require some money on average. Okay? And I don't know what long-term care is going to cost in 25 years from now, but I would love to have access to $1.2 million in cash, right? And oh, by the way, on a $1.6 million house, now you have access to a lot of equity relative to the value. Does that make sense? So this is just a simple chart that shows you the same thing. So again, your available equity is roughly $1.2 million, but your total equity in your home is actually $1 million. Okay? If you were to sell that house or pass away, because again, whoops, I went the wrong way, sorry. Which way am I going? There we go. So again, you owe $600,000 on a $1.6 million house, right? You have $1 million of equity in that house, right? Which is a lot more than you had day one. So you're not losing equity in this illustration. Does that make sense? Now, there might be some naysayers in the room, and it's okay if you are. So I put this slide together for anybody who might think that we will only see 2% appreciation in the future. Okay? If we only see 2% home appreciation in the future, guess what? Okay? Your home value, which again, this property value is the green one, I guess, in the middle. That's again now $1 million roughly, home value if it only appreciated 2%. But do you see the top green line of credit? That's $1.2 million. Anybody see a problem with this? There's a crossover, Bill. Guess what? That line of credit is still $1.2 million. Because the line of credit is growing at what? 675, which is the interest rate, not the home value. So in this case, you have access to $1.2 million of tax-free money in a home that you can continue to live in, not make a mortgage payment, and it's only worth $1 million. Go up to any financial advisor in the room and ask them how you can access $1.2 million out of your portfolio that's worth $1 million. Sorry, Mike, I'm not trying to be offensive, but I have yet to see how that works. This is the only product that I have ever seen that gives you the ability to access more than what the face value of the asset actually is. Cash value life insurance is probably a close second. Okay? So I'm going to give you an illustration here real fast. Okay? These are my 3 buckets. Bucket number 1 is your income bucket. Bucket number 2 is your nest egg bucket. Bucket number 3 is your home equity bucket. Okay? Let's focus on the top half of the slide for a second. This is when you're in your earning years. Okay? When you're in your earning years, when you're working, you're creating an income out of bucket number 1. right? You're earning an income, whether that's W-2, 1099, doesn't matter. You're earning an income out of bucket number 1, and you're spending money out of bucket number 1, right? Hopefully that's where all your spending comes out of, is bucket number 1. Now, if you meet with a financial advisor, they're going to likely tell you that you should put 5 to 20% of your earnings away in a nest egg or savings or a retirement account. Yeah? Why? For the future, right? For retirement. Okay? And if you meet with a realtor, what are they going to tell you? You should buy a house. Right? And when you go buy a house, guess what? Your down payment, you took cash, you put it into your house, now you have what? Equity. When you make mortgage payments that are principal and interest, what does the principal go toward? Equity. When you do home improvement projects and you fix the house up and the value goes up, what do you have more of? Equity. Okay, wonderful. You guys are tracking. So we're working, we're spending money. We put money into our nest egg. Remember that IRA and 401k we talked about earlier? That's all taxed. Yep, that's going into bucket number 2. We're making mortgage payments. We're going into bucket number 3 now, right? Now we go to retire. We're descending Mount Everest, right? Our income is reduced, right? Our earning potential is reduced. Where do we create supplemental income from typically? Bucket number 2, right? Isn't that why we put it there? Okay, we put money in bucket number 2 to supplement income. How do we put money into an IRA or a 401k or a cash value life insurance or whatever other tools that he's going to talk about to create supplemental income? Most financial advisors now are going to tell you this, and I might offend some people when I say this right now. Okay, if you are going to run out of money at some point, you have a couple of options. Number 1, go back to work. Number 2, cut your spending. Number 3, sell the house. That's what most financial advisors are telling clients. Okay? I'm here to tell you there's another option, and that is converting this home equity to tax-free cash. Okay? Using a home equity conversion mortgage. Okay? It's another option. Okay? It's an option that most financial advisors, fortunately I think the financial advisors in this room subscribe to my thought process, which by the way is simply based on research from guys like Wade Pfau and guys like Jamie Hopkins that are way smarter than me who have done all the math. Okay? They've proven this stuff mathematically. Okay? I'm just subscribing to their thought process and the math. Does this make sense? Okay? So I like to believe that the line of credit and the home equity conversion mortgage is like putting a spigot on your house, on your home equity. Okay? I put a spigot on the side of my house and I can open up that home equity and take equity out as I need it. And by the way, I haven't mentioned this, and I apologize I haven't mentioned this. With one of these mortgages, you are allowed to make payments at any time you want without any penalty. Okay? So many people actually believe this product is a payment optional mortgage or a pay option mortgage. You want to pay your loan off in 15 years? You can do that with this. You want to pay the loan off in 30 years? You can do that with this. You never want to pay the loan off? You could do that with this too. Try that with a traditional mortgage and see what happens. No, don't try that, okay? Don't try that because you will get foreclosed upon. Okay? This is the only option that you can make payments when you want, go on vacation and not make payments when you don't want. Okay? Anybody recognize her? Okay? On this day in 1987, First Lady Nancy Reagan, okay, came out, and I am not joking that there's a lot of symbolism here, but she came out and basically chose to speak openly about her experience becoming, or her diagnosis rather, and having a major mastectomy. Okay? And the reason I think this is important, and I just threw this slide in today because her candor helped break the stigma and raise awareness and inspire women across the country to take charge of their health. Number one, this program was created in 1987 under President Reagan administration, and I believe it has a stigma. I believe it has a stigma. And I am here to try and change that. That's a mission that I feel I'm responsible to follow through with. Bob, I'm going to call you up now, but I've asked Bob Helmuth to come up and just speak for 2 minutes, maybe 3, because I think there's a stigma, and Bob is not an actor. He's a real client. Okay, but come on up, Bob. And again, I want to introduce Bob. Him and his wife are clients and have become friends of ours. And again, I think that I appreciate you being here, Bob. Thank you.
Hey.
Thank you. But this is about breaking barriers and reducing the stigma. Because again, I think there's been a stigma with reverse mortgages. And many people I talk to will literally come to me 6 months later and say, Gabe, this was the best thing I ever did. I wish I had done it sooner, but I still can't tell my friends about it. Is that fair? Bob,
I don't feel that stigma.
thank you, Bob. So come on up and just
okay.
share for a couple minutes if you don't mind.
Yeah, I know. You're
Thank you.
telling me to just a few minutes because I can go on. But the first thing I want to say is thanks, Gabe, for having me speak about my experience with you. And it's been terrific. When I first met Gabe, and how many years ago was it? It must have been about
Yeah, it was
7, 8 years ago?
Yeah, it was
Maybe
2017, 2018.
Well, we've gotten to know each other well, and my wife and I, we found Gabe to be like the best teacher we've ever had. And you speak very clearly, you know your subject matter so well, and you look at who you're speaking to and you understand. You ask them questions, understand where they're at, and financially, and what their goals are, and what their aspirations are, and you enable them to understand the simplicity of this, which is a complicated issue. But it's not so complicated that it became beyond us because of the way you explained it. And I think that is something I really admire with you.
Thank you.
So to get a little personal, I'll tell you that my wife and I met in Tucson, Arizona. I'm from New York City. She's from Boulder. We met, we moved to LA. I was in the cable television industry for 20 years in marketing management. It was a good ride. And then I pivoted to another industry, and that's the financial services industry, where I worked for a financial services firm that focused on sustainable, should I say ESG? I might get screamed at because that's the backlash ESG is getting, environmental social governance types of investing that I can go on and on about, with. But we bought a home in Niwot. My wife and I, when we were in LA, we said we have 3 children, 3 girls. They like spending money. We like spending money. And we bought a house in Niwot, and that home, we're lucky to
Gorgeous
say,
home,
doubled in value. And we said we want more space, we want a larger home, a little more modern. We bought one. Gabe's been over to our home. And it continued to increase in equity. And the equity portion of our home, to your point, became one of the most important investment vehicles that we have. And we decided to complement our other investments, the 401k plan, I didn't use my Social Security until I was over 70. And we decided that we needed to, because we like spending money, we felt that the equity in the home could be of value to us. And I forget how we were introduced, Gabe, but I found you. And as I said, we were very taken by the reverse mortgage concept. And with all of the attributes that are involved in it, I don't personally see any stigma whatsoever. I just think it's a great investment tool. And I've told a number of my friends about it, and a few of them have gotten to call Gabe and also appreciated his clarity in making them understand the process and the benefits and some of the concerns that they had that we also had, my wife and I. So we're now selling our home because it's too much home, too much yard, 2 acres of land, and we want to simplify our life now. So when we do eventually sell it, it's on the market. Someone's going to love this house. And when they do, and we go through that process, we're going to knock on your door again, Gabe, and Nick is going to run some numbers for us, and we are going to get another reverse mortgage through you. So I'm just giving you a little bit of a perspective from me as a client and as a big believer in the reverse mortgage concept. And frankly, a lot of us that have homes in Boulder County have really need to look at this, because a lot of people are aging in place and asking themselves the same questions that you bring up that can be answered through a reverse mortgage. So with that said, I'm going to say thank you for giving me an opportunity.
You're welcome. Thank you.
To speak on your behalf for what you do, because I think it's extremely valuable as an investment process that can bring about many, many returns, as you mentioned.
Awesome.
So,
Thank you, Bob. Appreciate you. Thank you very much. I love those commercials when it's like, this is, a paid actor, right? We'll pay you through dinner tonight. But,
oh, that's okay, Gabe.
So I'll wrap up, as I know food is probably ready for you guys to go make a plate. But again, this is Dr. Wade Pfau. This is a quote from him that basically, use strategically, a reverse mortgage can greatly improve the sustainability of your retirement income. Okay? And with that alone, I suggest you ask yourself, why wouldn't you get a reverse mortgage at the end of the day?